thanks for tuning into this very special conversation on the eve of the Diwali celebrations. It's the Stocks for the New Samvat. We bring this every year around Diwali to give you a sense of what are some of the best minds in the investing world thinking about where they believe people, they themselves and maybe clients and other people can park their money. So three such guests consented to share two of their top ideas with us, and that is what we'll try and do on the show today. They need no introduction. You see them enough and more on various forms of media. But Vinay Khattar, Sudip Bandyopadhyay, and Deepak Shenoy join us, talk about their sense about markets and ideas. Gentlemen, all of you, thanks so much for joining in. Really appreciate having all of you. Before we get to the ideas bit, can I just get a very brief comment from each of you about how do you see the market and whether it's right for investing money at the current juncture, or would you wait maybe for a correction? We'll make it brief, but Deepak, can I start with you on that?
Firstly, thanks, Niraj. And, a quick round here. I believe markets are have gone up quite a bit, and then, you've got a lot of participation. But if you're a long-term investor, you should just look at this as one of the many investments you will make in the markets. So spread your money across a time period. And you will be fine whether it's overvalued or undervalued is relatively different. If you're a shorter term investor, I think it will make more sense for you to pick the kind of sectors that are moving up now and get out of that have some that have perhaps overheated. So the IT pharma goodness seems to have gone away. Banks seem to be back in favor. Maybe that's the short term trade for now. So it's going to be different for different kind of people, but I think the markets are going to do very well in the next 10 years, better than the last 10 for sure.
Okay, Sudip, and the same question to you really. When you are looking at parking money, is somewhat the time to do it, or let's be practical about it? Maybe the markets have gone up quite a bit, so maybe wait for a pause. What is your thesis around the basic investing in the markets currently?
Niraj, there is no doubt that the market has moved up quite a bit. Not only in India, but globally. And, you can call it a hope rally, you can call it a COVID relief rally. But end of the day, the liquidity which has been, around in the market is helping the risk-on mood of the investors. And that's why we see so much of excitement around the market. But having said that, I am a long-term investor and I believe advising on that. And if you're a long-term investor, if you're not trying to time the market just for short-term gains, I think there are still some excellent opportunities available in pockets. There are undervalued shares even today, which I believe investors should put in their portfolios. There is absolutely no point in trying to time the market for picking up these relatively undervalued stocks. And hence my conclusion is that today or tomorrow or this the Diwali day can be as good a day as any other day to pick up these stocks.
Yeah, as the wisdom goes, time spent in the market is probably better than timing the market. Vinay Khattar, the same question to you. And do you reckon that investments made during the current Samvat can reap rich benefits over the course of the next Samvat?
So without doubt, Niraj, if you were to hold on to a stock for a whole year, you would make money even from here, though the markets have really run up. Now, a few things which have played out very clearly. There has been a very strong liquidity which has driven both the developed market as well as the emerging markets. And this is specifically true for us because beyond the liquidity wall, the fundamentals, at least till previous quarters, were fairly challenged. This quarterly results have surprised most analysts, companies across sectors, whether that was on auto or consumption or chemicals. They have beaten analyst estimates by a margin. So some kind of a number risk is behind us. Next quarter would be extremely critical because most of the banks will come out of the moratorium. Their 90 DPD is ending in December. So banking stocks and the kind of credit offtake that we see, January is going to be a very critical month in terms of the results which come out next quarter, and that will provide direction to the market. Having said that, are you entering a market which is just a buyer's market? Our answer is clearly no. Valuations are fairly rich, so you'll have to pick and choose. And my sense is that sticking with sector leaders and segment leaders, even if you end up buying them a bit expensive, would be a better strategy than to go for cheaper stocks and end up compromising on quality. So stick to quality, stick to sectoral leaders, and it's clearly a buy on dip markets. So that's what we are advising our clients.
Okay. So Vinay, can I start off with you? What's one of the top ideas that you are recommending? Let's start with Zydus Wellness. Why do you like this? Why do you recommend this?
So Zydus, let me just take you through the history. Zydus launched sugar-free, Zydus Wellness launched sugar-free, and there were a couple of more products, but they were saturated in their categories. The Everyouth was a sub-100 crore brand. Sugar-free, which was almost 250 to 300 odd crores, had trouble growing. About 2 years ago, they ended up acquiring Heinz India business, which gave them a product basket which was very, very interesting. So they got Glucon-D, Nycil, which is a prickly heat powder, and above all, Complan. Now, Complan is a segment in which the market size is huge. It's almost a 10,000 crore market dominated by Pediasure. And Complan had been losing market share. So our sense is with this new product categories, and if they can get their act together on Complan, the growth, which has been a challenge for the company, could come back very vigorously. Second big factor, which we find very interesting, is the change in management, which happened about 2 to 3 years ago. Mr. Tarun Arora came in and he's set up an international business. He's done a lot of changes at the leadership level. A lot of new SKUs have got introduced, which is kind of getting growth back both on the original segments which were saturated and the newer product lines post the acquisition. Another big factor which is playing out is that post the merger with Heinz, their distribution reach has become almost half the size of HUL, which is a massive distribution footprint. And if they're able to use this distribution footprint well, the company could see their products flying off the shelves in next 2 to 3 years. So overall, the benefit of operating leverage, growth coming back to a certain extent, could all have their PAT jump up by more than 2 times in next 2 years. So it's an operating leverage game which is playing out, and adjusted for that operating leverage, to our mind, the stock was fairly valued and could provide a very decent upside from current levels.
This 2x jump in PAT, Vinay, is that a blue sky scenario, or would you reckon that that's the base case that you presume would happen? And if that were to happen, would multiples expand?
You are right on both. It is not a blue sky scenario. For us, we are assuming only 9 to 10% top line growth. So growth on the top line is not very, very aggressive. It is just that the balance sheet is going to lighten up very significantly. Debt is going to get repaid. Company is going to be generating cash flows worth about 400 to 500 crores. So that's a fairly strong cash flow generation, which will cause the size of the balance sheet to contract, the debt to come down, and the operating leverage to play out, leading to your PAT margins going up to as high as 20%. So it's not a very, very optimistic scenario. There is some degree of optimism definitely built in, but it's relatively safe to assume that the company will be able to achieve this bottom line numbers in a year or two.
Okay, well, watch out for Zydus Wellness. That's the first amongst the ideas that we'll talk about. Sudip, can I come to you for one of the ideas that you are sharing with us, and that is DLF. Now, real estate is probably the dark horse bet of a lot of people, but the usual suspects like Oberoi Realty, Godrej Properties, and Sobha get counted or get advocated. Why DLF?
Simple reason, Niraj, which I started mentioning to you, there are certain stocks in sectors which have also run up, which haven't been, which hasn't attracted investors' notice and fancy. DLF has been kind of beaten down mercilessly since the time RERA came in, and a whole lot of other regulatory changes hit real estate sector, whether it's the implementation of Ind AS accounting norms, whether it's the RERA, demonetization, GST. So, these companies which were structured in a different environment definitely did suffer. Also, the glut in the real estate market, particularly in NCR, where DLF has the biggest presence, did cause a lot of challenges for DLF. But over the last couple of years, a lot of things have happened in this space. And COVID also has taught a lot of lessons to the industry in general and real estate in particular. If you look at what's happening now, is that very clearly commercial real estate is picking up all across the country. We have seen the evidence of that in Bangalore and Mumbai markets. We understand that even Delhi is gaining traction as far as commercial space is concerned. We know how the REITs are performing, and there are a few REITs further lined up. Beyond that, I think residential, where again DLF plays a very large role, there are premium properties which are coming to the market, which are being sold even at current times when there is a general environment of uncertainty. So that does augur well for DLF. And remember, DLF has one of the best position in the market in Delhi, in northern India, and Delhi in particular. They have unutilized land banks in Chanakyapuri in Delhi as well as Gurgaon. Now, these land banks can be invaluable going forward, particularly the land bank in Chanakyapuri, which is the primest of the prime areas in New Delhi. Gurgaon land bank is also, of course, tremendously valuable. Now, all this will definitely significantly add value to the DLF balance sheet and profitability as things start improving and the economy start progressing. Couple of things also have happened. The DLF has been consciously working on cost reduction and managing the cost to income ratio in a much more meaningful manner over the last couple of years. Debt levels have been coming down, and it's being managed in a very pragmatic way, I would say, at this stage. The days of unbridled expansion, unrelated diversification, I think is a matter of past. The focus is on the core business, which is commercial and residential real estate. Focus is on utilizing and sweating the assets which they have and the resources they have. So all this does augur well. And as you mentioned, investors have been focusing on Oberoi Realty, Godrej Properties, Shobha, and the likes. Somehow DLF hasn't attracted that much attention and hasn't moved up comparison to the peers. So at current level, we find DLF attractive if somebody has a year plus kind of time horizon in mind, and they should look to buying DLF at current levels.
Okay, we will watch out for this one. Sudip kind of enumerated the small risks and the opportunities very, very well. So watch out for DLF2 viewers from a 12-month perspective. Of course, don't buy it just as a short-term trade. Deepak, Shenoy, can I come to you? Two interesting ideas. Let's start off with the stock first, and then we'll get to the other one. Well, can I ask you about why Info Edge, perennially touted as the one which has got very high valuations? Is there something about the next year IPO pipeline that leads you to do this? Why do you like Info Edge?
Niraj, Info Edge is more like a longer term investment, not just something that I think it will only last a year. But the reason why you're looking at this is, look at it in two different ways. You are actually today in an environment where a lot of the businesses that you use on a regular basis, you do not have any investing in. Earlier, you used to say that if you're using a Lux soap, please go buy Hindustan Unilever. If you're using a Titan watch, to buy the stock. The equivalent today is of the Zomatos and the Swiggies and the online websites that you might use a lot, maybe an Ola, maybe an Uber. You don't have any meaningful way to participate, and you can see them growing. They can be quite massive around you. Info Edge owns Naukri.com, which is a recruitment portal, one of the largest in India, perhaps the largest in India, almost de facto the place that people will put their resumes in at maybe the entry level resumes and early stage resumes. So this is going to be one of their largest moats, because other people have tried to gather traction in this space, but they've not comparatively succeeded anywhere close to Naukri.com. They have investments in real estate listings like 99 acres. They have something in the matrimonial area as well. These are direct ownership, but they also own 20% of Zomato. At one point, their ownership of Zomato was 50%. It's come down because Zomato has been raising funds from other institutional players, and they also own a significant stake in Policy Bazaar, which is one of India's largest insurance aggregators. So if you look at these are two unlisted businesses. that are looking to list soon. I think there's a IPO in the pipeline for both of these companies. One of them may list in India, one of them we don't know where. But the idea is that the valuation itself will give them this extremely large return on their investment that they've done over phases over a long time. They also have a significant amount of cash. They raised a QIP recently at 3,400 odd, and that cash is currently still available for them. They're going to utilize that to invest in newer or different businesses. They actually have about 15 or 16 other businesses in play. I believe at least the management is honest. The books are clean. I don't see anything that worries me from that angle, which is important. I think as an Indian investor, you have to be sure of that as well, or at least reasonably sure as much as you can be. But what is also important is that this is giving us access into the startup world where we cannot directly participate, and you're giving people who understand the scale of the startup businesses, where they will be putting a little bit of money in a lot of startups, and whatever kind of works will probably give them 100x, 200x kind of return. So your investment kind of goes there. So you're looking at this company, it's expensive. It's at 40,000 crores or so. But I believe longer term that, this company, if it does succeed, if it becomes this window to the startup world that I'm talking about, I think it could be valued at much more, 2x, 3x that. Of course, this will take more patience than 1 year. But I believe, strongly we own it in our portfolios, both in the PMS and our advisory portfolios. So, biased very much on that front, but I believe it's a good thing to have in the next coming years.
Okay, I was going to ask you about the valuations, but I think you laid it out for us, Deepak, that over a period of time, it could be valued much higher because of the nature of the business. No questions about the management quality, of course. I think they've already shown what a great business and a model that they've built, really. So thanks for that idea. Vinay, I'll come to you for your second idea, and that's Rosari Biotech. Now, this whole specialty chemical, API, that whole team merging together has done exceptionally well in the last 6 months. A biotech not being any different. Why do you like Rosari Biotech?
So Niraj, very well put that this is a theme which is in vogue, but we don't see it as a short-term theme, Niraj. We've been focused on chemicals for the last 4-5 years, and we believe that there is a massive value migration play happening out of China to India. So you are getting a lot of benefit of that. There is a sense of China plus one, where again Indian companies are being focused on. So there is chemical stock tailwinds which are playing out, which are resulting in very high growth for these companies and significant improvement in earning ratios and capital efficiency ratios and so on. And that's why you find that most of these stocks are trading at very rich multiple. Rosari, however, is slightly different. Not because it's trading less expensive, it is a fairly expensive stock. But here the theme is predominantly Indian. So company listed just a few months ago, and while we looked at the IPO, we found it rather on the higher side. The stock has even compounded from there. But once we took a deeper look at the company, you realize that what Rosari has been able to establish is very distinctive from a lot of other companies that are in the sector where you're playing value replacement or value migration cycles out of China. Rosari is significantly R&D driven company. They have 2 R&D set up, one in IIT Mumbai, second is in Silvassa, where they are producing application-oriented, tailor-made chemicals for need by 3 or 4 industries. So they are very strong on the textile side, which was the beginning, the early years of the companies. Last few years have been driven by home and personal care and performance chemicals. And personal care segment, as well as animal products, is going to be the future of the company overcoming, let's say, 5 or 7 or 10 years. Now, such a strong R&D, and promoters are from IIT Bombay with expertise in chemical engineering. This kind of strong expertise and relationship orientation has created a product basket for the company, which is very, very strong. they are able to price their products fairly expensively, given that it's a B2B business, given that you're competing with a lot of international majors. Still, companies able to command respect and margins both, and you get a sense of it once you look at the working capital cycle. It's less than 30 days, which is fairly good financial management of the business, and speaks about the quality of the products even against top-notch competition. Now, there are products like Vim, which, let's say, Lever makes and sells. But for the institutional businesses, the Vim has been outsourced by Levers to Rosari. IFB washing machine uses detergents, and you get an IFB branded detergent, liquid detergent, which is again manufactured by Rosari. So you are having this white labeling happening for number of companies, and these are all large players. Amazon is likely to be the next one where company will manufacture products on the chemical, on the surfactant side for Amazon. So this speaks a lot about the company's capabilities in terms of manufacturing of products on the home and personal care. In the personal care, again, they've started a new subsidiary that they are tying up with an online portal called Purple, and the entire manufacturing of products, a range of products, would be done by Rosari. So you find technical competence very well, and a sharply run business, very high return on capital, and a capacity which has just been doubled. So the capex has been done, and most of the money came in from the IPO, and that capacity is going to get utilized over the next 2 to 3 years. So it's a 600 crore business will become about 1,500 crore business, top line business, in next 2 to 3 years. So that kind of growth with a very strong moat on the business is, to our mind, makes a very, very interesting stock. So is it a stock that is cheap? Definitely no. So you should wait for opportunity. This is correct. This could be a very interesting bet with a 2 to 3 year perspective.
Okay, and it ties in with what Vinay said earlier, that it's a buy on dips market. Watch out for Rosari Biotech, a recently listed IPO or a recently listed company. Vinay Khattar likes it. Sudip, let's move on to the next one on your palette, and that is ITC. Now, very interesting. It's been a bit of a dog of a stock. The ESG metrics somehow seem to be going against the tobacco business. But is the unlocking, if it happens in the wake of we at least seeing some kinds of a vaccine coming in, drive some growth? It's been, let's face it, Sudip, it's not a stock that is now turned right. Why do you believe the next Samvat or the next 2 Samvats could be it for ITC?
Yeah, absolutely right, Niraj. It has not done anything for the investors for some time, and that's the reason I have been looking at it. And look at it this way. I start there. Look at the individual businesses which ITC has built over the last 10 years. If you look at all the individual businesses and try and summarize their valuation, it will be significantly higher from the valuation at which it is quoting today. Now, that's one small part of the entire equation. Look at the tobacco business. Yes, I completely agree on that ESG part. It's a dying business and pretty much everything else. But the fact is, let's look at it commercially. The kind of cash flow it generates and going to generate for next 50, 60 years, assuming the business is retained by ITC, which I'm sure they will. I think it can take care of pretty much everything else, the kind of free cash flow they generate. And that actually has been supporting their FMCG business to scale up and to do what they have been doing over the last 10, 15 years. And having said that, look at where the FMCG business has. Yes, if you compare margins and things like that, it hasn't yet achieved what a Lever achieves or other comparable FMCG companies achieve. But they have definitely built a sizable FMCG business, which will start kind of propelling the growth to a new trajectory in the coming quarters and years. And the initial signs of the FMCG starting to deliver results have already been visible in the recent past. This next point I think we have to also understand is that ITC, if you look at the peer comparison as far as valuation is concerned, now whether you want to look at the FMCG companies in general, or even you want to look at any of the segments and try and compare, ITC has been underperforming, and for multiple reasons, it has not been doing well. The next and also an important part of the equation is the investors are not happy, and there are a lot of noises being made, and there is a demand for doing something about it. The management has already declared that the dividend payout ratio and all that, and it's quite liberal. But beyond that, I think the investors are pushing the management to take some decisions on value unlocking. Our reading is that somewhere that will start happening, and the moment that starts happening, whether it's a hotels division or a paperboards division or an FMCG or even other the smaller businesses, getting parked in a new vehicle or some other transaction happening in those areas, I think the value unlocking will be significant. And I won't be surprised if the valuation then gets into multiples of the valuation today what we are seeing. Standalone, even otherwise, I think it deserves a re-rating at current levels. Quarterly performance, we have seen it was much better than what I think generally was being expected. And I see a significant valuation up move from current levels. If investors have 1 year's kind of time horizon, definitely ITC should be in their portfolio.
Okay, so that's the call for ITC, the one FMCG stock that hasn't performed, and Sudip believes one of the reasons could be that the different business segments perform and the valuation eventually plays some bit of a catch up. It's certainly, valuations are certainly in their favor. Let's see if there is an unlock and if that kind of helps ITC's other businesses like hotels, etc., to chip in. But the slightly different idea, and the last one on the show today, is from Deepak Shenoy. And Deepak, you are saying that aside, in addition to a stock recommendation, you're making an index recommendation.
Yes, Niraj. In fact, I'm saying, similar to what I was talking about in Naukri in terms of participation. Now we use products like Windows, Apple, so Microsoft products, Word, Excel. We use Google search. We use Facebook. We use a bunch of other online technologies like Slack and Zoom and so on. No real way to participate again in the growth of these companies. They've done really well. They're innovative. They have changed the way a lot of things are done. So they provided for infrastructure for the web. Amazon does that. Microsoft does that. There is Google search, which is now de facto on every mobile and computer. You've got to have some way to access or participate in that. And apart from that, the point is we've got a lot of Indian companies and a lot of great ones, which I think some of them have also been mentioned here in this show itself. But if you want to diversify a little bit and said, listen, we've got to have some of our allocations to outside India. Now you would typically say, oh, this is only possible if I'm a crorepati and all that. But now you can do it through mutual funds or through an ETF, an exchange traded fund, for as low as 5,000 or 10,000 rupees, and diversify away your allocation and into these companies, which is Apple, Microsoft. Instead of doing this on an individual stock basis, I would say just buy the index. It's just much easier. There's an ETF for the Nasdaq 100. There's a S&P 500 mutual fund. There's a Nasdaq 100 mutual fund as well. These are the funds. I would just focus on the Nasdaq 100 ETF, or you could buy the Nasdaq 100 fund of funds. The idea being Nasdaq has a lot of the tech companies. There's a good reason why I feel these tech companies will do well now. One of the big reasons is that despite what we've seen in terms of COVID and so on, perhaps maybe because of it, their earnings have actually gone up quite substantially. And this is some of this is a game where you say once you get enough people into this network, once you get enough people using Zoom, people continue to use it, and over time your subscribership only grows. So as usage increases, I think their profit pools will also increase because a large amount of technology is has extremely high gross margins, which means that it doesn't cost me so much to buy and get an additional customer as it does for me to have get the first customer. So the first customer costs me $100 million. but the millionth customer cost me like a fraction of a dollar because of the economies of scale. So because of that, I believe a lot of the tech companies, and they seem to be unnaturally concentrated in the NASDAQ and in the US. I think that's where a lot of the growth will come in going forward. So there are two interesting aspects over here. Firstly, in America, stocks are everything because you don't have fixed income. Deposit rates are almost zero. In Europe, they're negative. So you have to participate in the stock market in order to make any kind of returns. And people have their fortunes, their long-term allocations almost entirely in the stock market, or maybe partially some bonds which give them maybe 0.5% or 1%. Then most of the rest is stock. So you find that the political leadership also does not want to disturb the sanctity of the stock market, which means they will try and create measures which help the stock market, not bring it down dramatically. Therefore, you find that this is a natural push that leans towards these stocks. The amount of money that's being printed makes it much easier to build larger and larger technology-based companies because of relatively free money. People have money to invest. They will invest in companies that are upcoming, building new technologies, and these companies come float up and list on the US stock exchanges. Mostly, there's some that list in India, but mostly the innovative companies seem to be going and listing in the NASDAQ. So you get access to those as well, like Slack, Twitter, or some of the others. So the idea is to get into an index that has all of these companies in them. Now, the last bit is about valuations. Now, you think of this and say, oh, well, it's an all-time high. A lot of things are at an all-time high, including the Nifty today. But the NASDAQ price to earnings ratio is like 23 times. NASDAQ 100 price to earnings ratio is 23 times. The Nifty's price to earnings ratio is 31 times. So in comparison, a lot of the US stocks are actually cheaper as a whole than in India. They have a wider footprint, much larger revenues. What is small cap in the US may actually be a mega cap in India. And you get access to it for a small sum, so you can diversify as well. So I think all of these put together, good investment. I don't know if it will work in a year because a year is too short a time frame. But I think over a longer term, definitely this has in the last 10 years beaten almost all Indian mutual funds also by a handsome margin. But I feel that going forward, also the returns in rupee terms will be quite considerable.
And helps diversify as well as give you indirect exposure to some of the world-beating companies. Well, gentlemen, this was enlightening in more ways than one. And as I'm sure our viewers will figure out as well when they hear the whole show, there's some very powerful message in that, and on ideas on investing at large and on some different ways to go about doing it. Sudip, Bandyopadhyay, Vinay, Khattar, Deepak, Shenoy, thank you so much for joining me today. And to you and yours, a very happy Diwali and a prosperous New Year from all of us at BloombergQuint.
A very happy Diwali to all of you. Thank you.
Thank you so much. And viewers, thanks for tuning in to this very special episode of Stocks for the New Samvat.